Welcome to my YouTube channel. In this video, we will talk about how to invest your first $1,000. Index funds. Whether you can invest $1,000 or $10 million at the moment, it's always important to remain diversified. Successful investors balance potential gains with downside risk and investment fees. The potential upside needs to be higher than the potential risk and costs to make money. Index funds can be your best starting point because of their low costs and instant diversification. Many early retirees use index funds as a portfolio cornerstone. These funds track a specific market index and have a position in each company within that index. A single share for several S&P 500 companies costs more than $1,000 each. Instead of only being able to buy a handful of shares for your favorite companies, buying the index is the easiest way to get exposure to the broad market. As a result, you can instantly diversify your portfolio. In addition to the instant diversification benefits, index funds have some of the lowest expense ratios. Low investment expenses mean more of your cash invested, so you can earn more income. Index funds have low expenses because they follow a passive investment strategy. Instead of trying to beat the market, index funds seek to match the overall market performance. You can buy index funds as either or mutual fund or ETF at most brokerages with no trade commissions. You may need to buy ETFs by the share if you can't afford the investment minimum for the mutual fund version. While it's not hard to invest in index funds, you may be initially overwhelmed by all of the options. Consider this 3-fund portfolio to get exposure in the US and global markets. Target date retirement funds. For a more hands-off approach, you can pick a target date retirement fund. For example, you would choose a 2050 target date fund if you plan to retire in 30 years. These funds typically invest in index funds with age-based risk tolerance. As your projected retirement date approaches, the fund increases its allocation of less volatile assets like bonds. You may appreciate these funds if you don't feel confident rebalancing your portfolio. The minimum initial investment can be less than buying an index fund. Vanguard, for example, only requires $1,000 to start investing in their target retirement funds and $3,000 for index funds. As the fund manager plays a more active role, target date funds have higher expense ratios than index funds. Some target funds are more active than you might realize. As a result, their investing strategy may be more aggressive than you're comfortable pursuing. Certificates of deposit. If you still have several decades until the traditional retirement age, most of your assets should be in stocks and equities. These assets have more risk but also have more long-term potential income, so you can afford retirement. You might park some of your cash in a bank certificate of deposit, CD, if you're not putting the entire $1,000 into the market at once. These products pay a fixed yield for a specific number of months. However, your current annual returns won't outpace inflation as most CDs yield low single-digit APY at best. Your brokerage high-interest cash management account is a similar alternative. The yield might be less than a bank CD, and it isn't fixed for a term, but you have near instant access to your cash without penalty. Individual stocks. New investors may have a burning desire to invest in individual stocks for their favorite brands. Maybe you have your eye on a dividend aristocrat. Individual stocks are inherently riskier than a mutual fund or ETF. Until your portfolio balance expands, it can be difficult to buy stock and remain diversified. A wise strategy can be buying an index fund or target date fund first. Then you can buy a high-quality stock with any remaining funds. Take the time to ask these investing questions first. Zero trade commissions and fractional investing make owning individual stocks more affordable than ever. Choosing a broker with minimal cost barriers for funds and individual stock can make investing easier as your portfolio grows. Alternative assets. Stock market alternatives are another popular investment trend. Some of the private assets you can access include crowdfunded real estate, precious metals, cryptocurrency, small business loans, peer-to-peer loans. Thanks to investing rule change in 2012, average investors can invest in private equity markets with small amounts of money. These assets were previously only available to accredited investors and those with plenty of free cash. These assets have a more exciting investment story and can outperform the average stock market return. However, these assets each have their own unique set of risks. Their fees and investment minimums can also be higher than index funds and target date funds. Crowdfund real estate may not produce negative returns like a real estate index fund can during a broad market correction. However, crowdfunding real estate can lose money if the property sells for a loss or the borrower defaults. Also, crowdfund assets may have a multi-year investment commitment and can take several weeks to sell. You will likely pay an early redemption fee if you sell your position prematurely. In some cases, the platform may not let you sell if market conditions deteriorate. You might try focusing on alternative assets once your portfolio is larger and can absorb riskier assets. And once you have a firm understanding of how these stock market alternatives can make or lose money. Best investment account for new investors. Which assets you invest your first $1,000 in is vital to starting a healthy investing career. The type of investment account you open is also worth pondering. For example, retirement accounts like a 401 or an IRA minimize your taxable investment income. However, most withdrawals before you turn 59.5 years old are subject to an early withdrawal penalty. Taxable brokerage accounts require you to report your sold investments and dividend income on your annual tax return. Yet, you can have penalty-free access to your investments. Here are the highlights of each investment account type. Choosing the best account can help you maximize your investing power. 401. Plan. Your employer provided 401. Plan is the first investment account for many. One reason why is that you can withhold money directly from your paycheck. If the funds must first reach your paycheck, you may use it to pay bills or save for upcoming expenses instead. Another incentive is if your employer offers matching contributions. These contributions grow tax-deferred, and you pay income tax on the withdrawal amount. This tax treatment holds even if you have a raw 401. Still, the match is free money that instantly makes your $1,000 increase before you get your first dividend payment. What do you think of our video? Let me know in the comment section below. Before you go, please hit the like button and subscribe to my channel. Thanks for watching.